What are the mistakes to avoid when choosing a debt mutual fund? Industry expert Mr. Hariharan will share his thoughts with you now. Hari, over to you.
Some mistakes that investors should avoid. One is investing purely based on past returns of the debt mutual fund. Now, in equities, you can take this risk, okay, because you know that in a 10-year time period, all funds will do well, isn't it? So that risk is possible. You look at historical performance of equity funds and you extrapolate and say that if that fund has given 15%, very high possibility it will give 15%. Even otherwise, equity will tend to give 10-12%. Right. But in debt, it does not work because your interest rate scenarios could have changed the return that you say. So today, when you look at the interest rates, we are looking at a peak of the interest rate cycle. All these instruments, as I showed in that slide, have gone up. So, and if you therefore say that, oh, my liquid fund has given 6.5, let me put my money in the liquid fund. Will it give next 1 year 6.5? I don't know. So just don't go blindly by what has been the past returns and say that this fund has given very good performance last year. Therefore, let me invest in this fund is not the right way to do. Instead, you look at something called as YTM, which is yield to maturity of that debt mutual fund. So in essence, it tells that if I hold that debt mutual fund till the maturity of the fund, and every fund you have those data points available, what is the maturity of the fund, what is the YTM, it says that if I hold it till its maturity, I should expect that returns. Please remember, I'm using the word expect. It is not guaranteed. I am not a great favor of YTM based investment, but relatively between past returns, it's better to look at current YTM because that will give you a better estimate of what you can get, right? So past can be misleading. Current YTM is a better alternative than past returns. That's one thing that you need to look at. Second, ignoring interest rate risk in the fund or duration of the fund. So that's again an important part. As I said, interest rate changes, prices move in opposite direction. So timing becomes a bit of a important point here. Today, we are looking at an interest rate peak. Maybe 2-3 months back, we were expecting that RBI will start cutting interest rates in this year itself. Today, the commentary seems to have changed. Today, we don't see RBI cutting interest rates before the Q1 of next financial year. So that's how it has got a bit delayed, which means this higher interest rate scenario is going to sustain at least for the next 6 to 9 months in the country. And therefore, that's an opportunity to lock in to certain debt mutual funds at these high interest rates. Because if interest rates come down, you will also face a fall in interest rates in some of the debt mutual fund. If interest rates come down, some debt mutual fund will do very good. They will give very good capital appreciation. Okay, so look at interest rate risk. Gilt funds can be extremely volatile. Gilt funds are funds which will invest 80% of the money in government securities, and therefore the thought process is that because the money is going into government securities, it will be completely risk-free. Credit risk is not there. Interest rate risk is highest in a gilt fund. So you need to be wary of it. Otherwise, you could face significant capital losses. So to consider the interest rate risk, you look at certain parameters like modified duration, which basically is a measure of the interest rate sensitivity of the fund. So if the interest rate changes by 1%, how much will the price of the debt mutual fund change in the opposite direction is what modified duration tells us. Again, from an investor perspective, you may not want to get, because you have an advisor in place who can take care of all these, but it's important to consider and look at some of these. No, the third is to ignore credit profile. So every mutual fund gives a portfolio of what is the issue, who are the issuers in that portfolio, and all these issuers have a rating which tells us what is the credit risk in that particular fund. So if it's a AAA or a sovereign rated, which means that the credit risk is very, very low, practically zero. If you go to a A-rated paper, is where there's an increase in credit risk, and so on and so forth. And the SEBI classification also is done in a way that some of these classifications are based on the credit profile. So a credit risk fund, for example, will invest 65% into non-AAA, which is not the safest kind of papers. So somebody comes into credit risk, comes with a complete awareness that there is an element of credit risk here, right? So look at credit profile also. And finally, something that is followed in most investments is the herd mentality. Suresh has invested in this fund. I also want to invest in this fund. Suresh's need is different. Your need is different. Your risk appetite is different. Your goals are different. Your time period of investments are different. So don't just copy the behavior and the schemes of what others have done. Again, in equity, they may work. In fact, that also we are not supposed to do, but you can still take a chance with equity. In debt, it will not work. So these are some of the things that you should take into consideration.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also, you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.